Let's connect with Feroze Azeez, who's the Deputy CEO at Anand Rathi Wealth, to understand these market conditions right now and how these SIPs are growing. Feroze, good to have you with us. A very good evening. These SIPs hitting record highs. What do you put it down to as of now? The kind of confidence that investors seem to have, or is it the lack of asset classes right now that is making them more and more attracted to the equity markets?
Good evening, Vikram. Like you said, there is improved investor confidence, but there are three things which I think stand out. Is of course, in fact, we had predicted a 25,000 crore SIP number by March 2025, and the SIP numbers were 7,000 crores. I personally think that we are still scratching the surface. If you look at the Indian total household savings, we have about 720 lakh crores, give or take, in Indian households as savings. Today, we are speaking of little over 50 lakhs in mutual funds put together. That's 6-7% of India's household savings. If you look at equity mutual fund as a percentage of the total household savings in India, it's less than 4%. So we are still scratching the surface, point one. Point two, so what I'm trying to get to is even the 25,000 per month will happen and 50,000 crores a month will also happen because the total context in which these numbers are to be seen is the entire household savings of India. Point one. Point two, investor confidence has gone up on the back of education, which has started in 2013. It has taken time for that to show up. AMFI and SEBI have done a brilliant job in educating Indian investors with a small little budget from the existing investors, which is 0.02%, which runs into hundreds of crores every financial year. And that's resulted in the right confidence because this is the most transparent platform for retail investor. And so the confidence is rightly there. And thirdly, I personally think that the equity as an asset class, I think is being better understood, is why for 2 years markets did nothing till October. Of course, we are at the peaks now. November and December have been good. But if you look at the previous 2 years, October 21 to 23, markets did practically nothing. Nifty was 18,500 to 18,800. Still, the SIP number went up from some 9,000 crores to 17,000, 16,000 crores till October, which means that people are not coming for the greed of it, but education has had a large role to play in the paradigm shift.
You seem pretty confident about investor confidence in the markets. Do you think that's what's going to keep the momentum alive in the markets, the kind of run-up that we've seen in 2023? There are a few questions about valuations. There are headwinds, Indian inflation, US inflation. We read the minutes of the last FOMC meeting where the timing of rate cuts didn't give that clarity that perhaps the markets would have liked. How will these factors affect India's retail participation this year? Will they get the dips to buy further? Will they go ahead and buy further? Should they use those dips? These are the questions that come to mind.
So very pertinent questions which a viewer would want answers to, Vikram. So you're asking the most relevant question. So if you ask me, I think there are three things. Of course, the liquidity on the domestic side is one part of the liquidity. The other part of the liquidity is the foreigner liquidity, the FII liquidity, which has been close to 60,000 crore plus in December. Because of the state elections and the probability of continuance of the same government went up dramatically after the state elections, and FIIs love continuity, irrespective of the government or the party which rules the country. They love continuity. So continuity probability resulted in 9,000 crores in November, and December was 60,000 crores. So liquidity both on the domestic and the foreign institutional side seems robust because the domestic guys are putting money out of education and foreigners are putting on the probability of the continuance of the government. That's point two. Point three is earnings have been very, very heartening. We predicted earnings growth when earnings growth was 532 in FY20. 532 became 777 for Nifty per piece, became 820 in the next year. This year we were predicting 945. We are already projecting 960 now because the earnings have been healthy. And next year we're projecting close to 1100, 1080 kind of earnings. So earnings has also supported macroeconomic variables. 7 of them I track as a company. 6 of them are in deep green. Like you rightly said, there is headwinds. Global headwinds are more relevant for the global markets because India inflation and interest rate is business as usual. It's not something which is new to us. We've lived with it for decades.
In that sense, Feroze, how fairly priced are the markets right now? Because there are different perceptions of this, and where do you see the biggest opportunities of a climb up from where we are right now, the sections of the market perhaps that haven't been part of last year's bull run, perhaps when you're picking and choosing the kind of mutual funds that you'd want to park your money in? How do you go about it in these market conditions, and what is being projected?
Vikram, you have two questions intertwined, so
Yes.
I'm going to first bifurcate that. From a valuation standpoint, it is no more a generic market. It has become a divergent market. If you look at the top five or NSE 500 companies, which are not necessarily the top 500, which is the common belief, but the 500 NSE 500 companies has 34 companies greater than 100 P, has about 160 companies greater than 50 PB. So I can't make a statement that we are not overvalued. Neither can I make a statement that we are completely overvalued, because there's also another stock with 10 P. But the dispersion in valuation has become dramatic. That's point one. So the name of the game is being more specific. The devil is in the detail for FY20 or calendar year 2024. So that's where a fund manager or a mutual fund becomes a better platform than direct equity. Last year could have been a great year for direct equity, but this year is going to be being very specific, being very choosy, because the valuation dispersions are at the 3 sigma levels they have been seen in the past. That's one thing. Now coming to how do you choose a mutual fund? In our opinion, choosing a mutual fund on the basis of what are the probabilities of beating Nifty is the best mechanism. So we developed a model, a statistical model, and evolved that over the last 11 years. So we use several parameters, including target NAVs, which are quite unique, and the right to wrong ratios of a fund manager. Having said which, we believe that 50-55% of the money should be in large cap, about 20% in mid cap, 30% in small cap for the moment. I think in the next 3-4 months, it might just be time to get some money off the table from small cap, which we went overweight last year.
Good advice, Feroze. It's always a pleasure getting in your perspective. Thanks so much for joining us on India Tonight for lending that helping hand for our investors.